Hey everyone, welcome back to another great webinar. I'm Daniel Snyder from Seeking Alpha. Today, you know what's happening in the world? Well, the government is shut down, but you know what's not shut down is that we are here trying to give you value. 5 stocks here that Steve, Kress, and the Quant team have put together. So before we get into the conversation today, I want to go ahead and get our legal disclaimer out of the way. So, we are not advising you personally concerning the nature, potential value, or suitability of any particular security. You alone are solely responsible for determining whether any investment, security, strategy, or any product or service is appropriate or suitable for you based on your investment objectives and personal and financial situation. This presentation is for information purposes only. Content is presented as of the date published or indicated and may be superseded by future events. It represents my opinions and Stephen Kress's opinions, which may not reflect the views of Seeking Alpha as a whole, and past performance is no guarantee of future results. Seeking Alpha is not a licensed securities dealer, broker, U.S. investment advisor, or investment bank. Now, Steve, I'm excited about this one because this webinar actually was a request quite a while ago about help me find, these undercover names in the market. I think people are always hearing AI this, AI that, tech this, tech that. So to focus on mid caps, I'm excited to see what you brought together today.
Yeah, I think we brought together some really good names. And based on the way the market has been trading, which is, we have the market near all-time highs, but we've seen a lot of rotation occur within sectors and movement to safe haven areas in the last couple of days. So I think there's a lot of uncertainty, but there's also the prospects of rates going lower. So I almost feel like many of these stocks we have already started to come up down a little bit. There's been a correction in a number of these stocks that have great fundamentals. So it's sort of reflecting that rotation that we're seeing to safe havens, like I mentioned, cash or consumer staples, out of some of even the mega tech stocks. So we're going to get into the presentation, but for those who are new to Seeking Alpha, a little bit about my background. I've been in the world of finance for almost 35 years. Much of it on Wall Street and in the city of London. The bulk of my career was spent at Morgan Stanley, where I ran a prop trading desk in quantitative strategies. I also headed up international at Northern Trust, and I founded a hedge fund. And I guess I was a little bored when I founded the hedge fund because I also founded a fintech company that was acquired by Seeking Alpha. And that is what brings me here today. So we're going to get into our quant system a little bit. The presentation will cover why quant, a little bit about the market backdrop, mid-cap stocks going into the rate cut cycle. And I almost wish I could have named this presentation, mid-cap stocks buying on the dip, because I already feel like a number of these stocks have started their dip. And for me, that's really attractive. And of course, our 5 top mid-cap stocks that we're going to be recommending. So what is quant? Well, I often say quant is really very similar to what a conventional investment analyst is. If you had an analyst at Goldman Sachs or Morgan Stanley or Merrill Lynch, our quant system pretty much reflects the way an analyst at one of those organizations works. We look for fundamentals. What's core to our particular model is we look for stocks that are collectively strong on growth, value, profitability, consensus upward EPS revisions, and momentum. So many analysts will look for those attributes as well. But the big difference is when you're an analyst and you're a human being, you're only capable of maybe covering 10 to 20 stocks at a given point. And you can only write on maybe each stock that you cover, perhaps, once a month, maybe twice a month. Where with quant, when we use the power of processing in computers, we can analyze every stock every single day. And that's exactly what we do. We measure companies' cash flow statements, income statements, balance sheets, and hundreds of financial metrics for each stock compared to its sector. So it enables us to give a directional recommendation, a buy, sell, or hold that is refreshed literally on a daily basis. So that's what I love about the power of quant, that it gives me ability to look at a universe of 5,000 stocks, where when you're an analyst, and I was an analyst at one point, you're really limited in the quantity of companies that you can cover. So we have a pretty good history too. Here's our track record. This goes back about 5 years. Our overall track record goes back to 2010, which is even more impressive, but we want to keep it in recent history. So if you look at the far left side, you'll see if you looked at all our quant strong buys as a portfolio that gets rebalanced on a daily basis, you would see the quant strong buys are up 240% over the last 5 years. That would be compared to Wall Street analyst strong buys, which are up 49%, and the S&P 500 up 77%. So our quant system has done a great job against Wall Street strong buys and has handedly beaten the S&P 500 over the last 5 years. Now let's get into the current market environment. It is not really a straightforward picture or a clear vision. And I think we're seeing that in the market today. The NASDAQ is down almost 2%. We had some choppy trading earlier this week and last week with some up days, some down days, pretty large swings. What we're seeing right now is in terms of interest rate traders, about 70% of them expect a rate cut in December. In the previous months where we had rate cuts, it was virtually 90% to 100% of traders were expecting a rate cut. Now we're sort of at a 70% level, and that's really because of Fed Chair Powell and the guidance that he gave during the last rate cut. Inflation is still proving to be sticky, and one of the main drivers really behind cutting rates was actually the labor environment and weakness that was seen. And it is the Fed's responsibility and mandate to balance both employment with inflation within a range of 2%. Inflation, as I mentioned, has been stickier than they would have liked, but the unemployment situation has been volatile, and they want to avoid a situation where there is growing unemployment. So those labor concerns continue to linger over the market. However, as we're going into December, they're reaching a point where between labor and inflation being sticky, they're not sure that they can actually take rates down. So those rate cuts may have been discounted into the market, and perhaps that's one of the reasons why we've seen some choppy trading. So highlighting that, the government shutdown as well is now the longest in U.S. history, creating a void of official economic data and leaving policymakers with very limited visibility into current conditions. Not to mention the negative impact that it has on the economy the longer that it goes, because so many people are not getting their paychecks. Earlier this week, the ADP had showed that private sector hiring was growing, but the markets dropped today on the back of a Challenger report, which revealed the highest October job cuts since 2003, making the labor market outlook increasingly complicated. So on one hand, you're showing a rebound in private sector hiring. On the other hand, you're showing massive job cuts starting to occur. Again, the highest since 2003. And that's highlighted on both the charts at the bottom. On the left-hand side, you can see the ADP national employment chart. And on the right side, you can see the Challenger Gray and Christmas chart. And that is definitely a huge swing up on the far right-hand side, as you can see in job cuts. And we're beginning to see that in the headlines almost every day. It seems like, one big technology firm after the other is starting to make cuts. And we're seeing it in the sectors as well. So what we're looking at here, if you go to the far right, you'll see the 1 month, 4-week performance for U.S. equity sectors. You can see over the last month, healthcare, consumer discretionary, and financial services have been the top leading. And really, it's actually, this is not quite sort of the way that I wanted it to do. So what I'm going to actually do is go to the platform. We're going to go to this live, and we're going to take a look at the sectors and take a look at today. Okay. So today you could see consumer discretionary, technology, communication services. Those are the worst performing sectors, and those have been for quite a while the best performing. So now if I take a look at 1 month and I sort it by that, you'll see over the last 4 weeks, technology, consumer discretionary were the best performing sectors. Today, they are the worst performing sectors. So you're seeing a bit of a rotation. If we look at the trends for the last 5 days, you can see healthcare and consumer discretionary were doing well, but communication services and technology continue to perform poorly. So that 5-day trend is continuing. So a lot of uncertainty in the market, but we're still close to those highs. I'll take us back to the slide deck now.
And that's a good thing to point out, Steve, is there's a lot of volatility going on lately with the lack of government data and people watching Supreme Courts and tariffs and all the things that you're about to dive into. But also, we're not that far off of the all-time highs yet. And history has shown that these little pullbacks usually get bought. So we're going to see what happens, obviously. But it's a good point to bring up.
Yeah, and I'm glad you do highlight that. We're not far off the overall index highs. And it's one of the reasons why I like these mid-cap stocks is because some of them have already begun to sell off ahead of the indexes. And to me, that's an attractive opportunity. So we'll get into that a little bit more when we pull up the charts on the stocks. So there are, being that we are near the index highs, here are the risks that are lurking beneath the surface. First and foremost, the stretched valuations. Equity valuations are elevated versus their 5-year and 10-year averages. And that definitely suggests some vulnerability to a correction if the sentiment continues to be negative. Secondly, markets have fully priced in a rate cut. As you can see, there are fewer traders now that are expecting rate cuts, and that could be baked into the market. If the market doesn't continue to get rate cuts and we don't see good economic news, that as well could perhaps be the catalyst behind a correction. Then we have the tariff uncertainty, which is uncertain anytime where the White House is sort of leveling up their tariffs, then pulling back the tariffs. But now we have the Supreme Court reviewing even the legality of the tariffs coming from the White House, because by law, it's actually Congress that should be levying tariffs and taxes. So the argument being that it's unconstitutional that the White House has led the tariff increases. And we don't know what's going to happen with the Supreme Court. They've begun to hear the arguments, and it could be weeks, if not months, before they issue a decision there. And lastly, the government shutdown. It doesn't seem like there's any progress really taking place, and it already is reached its historical longest period. And the longer that it does go on, the worse it is for the economy, because that really does take a lot of salaries out of the economy. And the longer it goes on, the worse it gets. So mid caps, okay, could be the sweet spot for growth and stability. A lot of the large caps, which have reflected in the indexes with really high concentration levels, are near all-time highs. When you look at small cap stocks, typically they do well in an environment where rates continue to get cut. We are expecting rates to decline, but it's on pause right now. So mid cap stocks kind of put you in the sweet spot between large cap and small. So while a rate cutting environment can spark growth opportunities, lingering risk like inflation and fiscal policy does raise concerns. So holding the mid cap stocks could be beneficial. Defined as companies between market caps of 2 billion and 10 billion, they offer a balanced path between blending the resilience of larger firms, as I mentioned, and the upside of smaller stocks. And here you can see a chart that shows US small cap stocks, mid cap stocks, and large cap stocks today and over the last month. What the trend is. The trend is the market has been hitting its all-time highs. You can see large cap stocks at the top there. Mid cap have not done well, and small caps have actually performed poorly. But again, I think part of that reason is the market. Sometimes when you're looking at the overall indexes, it's a little bit deceiving. Now we're beginning to see some volatility with the indexes, but some of that volatility with the small and mid cap stocks, apparently, when you look at this chart, have occurred going back 4 weeks. So you can see the small cap and mid cap stocks to a certain extent have already come off being the indexes. And when you look at the underlying names, you'll see that they've come off even more. And to me, that's a buy on the dip opportunity. Building resilience, why mid caps matter now. As I had said, mid cap stocks strike an effective balance between both growth potential and manageable risks. They tend to be more domestically focused as well, making them more insulated from the tariff shocks. And mid cap stocks are an important diversifier for a portfolio. Many of them overlooked as people look for the mega cap stocks or the large cap. They don't look for the mid cap stocks quite as much. But you can see by looking at this chart on the right-hand side that the mid-cap stocks have historically outperformed both large and small cap stocks. So very interesting chart. And this goes back to 1978 for a hypothetical $10,000. The Russell mid-cap hitting 2.6 million, the Russell top 200 1.85 million, and the Russell 2000 at 1.21 million. So mid-cap stocks leading the way over a very long period of time. All right, without further ado, that is going to bring us to our mid-cap recommendations. So we're going to start with SSR Mining. This is actually one of the few that has not come off quite as sharp as the others, but has come off a little bit in recent days. SSR Mining has a market cap of 3.96 billion, and it is a quant strong buy. Within the materials sector, it is ranked our number one stock, and within its industry of the gold sector, it ranks 47 within that industry. This is a mid-tier precious metal producer operating gold and silver mines across North and South America. Some terrific numbers here. I'm actually going to take you to the platform. So we're going to go to SSR Mining, and we are in the premium platform. And you can see year to date, the stock has been absolutely stellar with a return of 185%. But I don't want you to feel like you're chasing the stock, because if you look at the factor grades on the right-hand side, you can see the valuation with a grade of an A, which shows it's very attractive compared to the sector. If you look at it where it was 6 months ago, it was an A minus. So despite the stock going up 185% in the year, the valuation is actually more attractive now than it was 6 months ago. However, you will see in the last 5 days, the stock has come down a bit. There's been a bit of a rotation out of the sector, although today it's definitely fighting the tape. The stock is up 1.54%, with the market being down today, especially the Nasdaq down almost 2%. I want to bring you into the valuation for this company so you can see where it stands. As I mentioned, is in the materials sector, and it ranks number one in the sector out of 277. This has almost a straight A report card. From a valuation perspective, if you look at on a forward PE basis, it is dirt cheap. You can see it's an A with a current multiple at 10.14 times versus the sector at 18 times. So the stock is at a 44% discount to the sector, and that's on a forward PE basis. It has some very other attractive metrics as well. If you're looking at an EV to EBIT, it's at actually an A plus versus the sector at a multiple of 7.8 times versus the sector at 15.4. So the valuation framework looks great. If we take a look at the growth for the company, we can see the forward revenue growth rate is 14.85% versus the sector at 2.8%. So a whopping 420% premium to the growth of the sector. That is absolutely huge. And if we look at it on an earnings basis, we can see the forward EPS growth is 38% versus the sector at 8.3%. And if we look at the long-term growth for the company, which is a 3 to 5 year CAGR rate, analysts have it at 114%. So our forward growth actually takes the consensus of analysts, while the year-over-year numbers show the actual history having been reported by the company. So this stock looks great on value, growth, profitability, momentum versus the sector, and positive analyst revisions. Let's
Hey,
see what we have.
hey,
Yeah,
Steve, real quick, if you could go into the quant grade. So there was a chat that just came in as well mentioning this company just reported earnings on November 4th, and there's been a little bit of a pullback in the stock as well. But if you look at the quant rating system and go into the historical look of all the grades by day,
sure.
not this tab, but yeah, go back to ratings and just scroll down to the quant rating history there, you'll actually see because of the pullback, back on the 4th, it was trading around 2170, and today we're around 1970. The valuation grade has actually gotten better because of the price pullback, but those grades really haven't changed much. And remember, the quant rating system updates every single morning. So it has all the new data coming in from the earnings calls and any
Every day.
change of, EPS revisions or revenue revisions from Wall Street analysts. And these grades haven't changed in the last 2 days, even after that earnings call. It seems like there's still positive sentiment here for mining, specifically with the gold run up and everything we've seen this year. So it's an interesting company for sure.
Yeah, and the stock, did have a bit of a pullback as I showed over the last 5 days. And as we look at earnings, they had reported on the 4th, and it was a miss by 11 cents, and a little bit of a miss on the revenue side too. If we look at the historical quarters, you can see for the most part it's been pretty strong. Actually, really strong for the most part. Just a couple misses, and I think we saw that pullback, which, as I showed, was about 5%. It was 12% in the last 5 days. The stock is suggesting with the down market being up 1.54%, that pullback is probably over at this point. Let's go back to the presentation, and we're going to go to our, we'll enlarge that slide deck again, and we'll go to stock number 2, which is TTM Technologies. Market cap is 7.24 billion. This is in the information technology sector, and it currently ranks 11 out of 540 stocks. And within its industry of electronic manufacturing services, it ranks number 1 out of 18. And they manufacture printed circuit boards and RF components. And they have some just tremendous growth here. You can see their forward EPS growth is 29%. In terms of their cash per share, even though that overall profitability grade is a C minus, there are some margin numbers that don't look great. But the fact that the company has $4.75 per share, that's one of my favorite profitability metrics. And that is absolutely huge versus the sector. ROE is currently at about 8.12%, and that puts that at a 48% premium to the sector. On a peg basis, it's at about a 49% discount to the sector. And as you can see, it's gotten a little rich. I'll go to the platform, and we're going to take a look at TTMI. So it is that quick to pull up stocks. If you're not familiar with our platform, you literally can put the name or the ticker symbol in, and it comes up right away. So you can see this stock has not really had a pullback. So year to date, it's up 175%. Over the last 4 weeks, it's up 11%. So it's continued its upward trajectory. The valuation is a bit more expensive now compared to where it was 6 months ago. However, the really important however here is growth has a grade of B versus 6 months ago where it was a D plus. So one of the reasons why the stock has appreciated so much in the last 6 months is that it's got a different growth outlook than it did before. So we're going to click into growth and we're going to see what's going on here. And we see a lot of green. So year over year, it had some pretty good revenue growth numbers at 17.8% versus the sector at 8%. The forward growth outlook is 12% versus the sector at 7.64%. If we go down to the bottom line, earnings per share diluted growth is now 29% going forward. So that number is higher than it was 6 months ago versus the sector at 12%. So that's one of the key reasons why we've really seen this stock do so well. And year over year, they've reported some great numbers. Year over year, earnings per share is up 90% versus the sector at 13%. So one of the reasons why we highlighted the stock, despite the valuation not being as attractive as it was, is the fact that the growth is so much stronger. Momentum for the stock has been very strong, and analysts continue to support the stock by taking their earnings estimates up for it. We'll go back to the slide deck. And we're going to go to stock number 3, which is Power Solutions International. They have been a real benefactor of the emergence in data centers and AI. This company was really more of a small cap company. It's just moved into the mid cap territory with a market cap of $2 billion. It's within the industrial sector, and it ranks 7 out of 620. And within its industry of heavy electrical equipment, it ranks number 1 out of 13. And they specialize in the design and manufacturing of emission certified power systems, which serve data centers as well as industrial and transportation companies. Some great growth numbers here. I'm going to go into the platform so you can see it. So this is Power Solutions International. Now you can see this stock has definitely had a pullback. It was as high as $110 on September 3rd, and now is down all the way to $81. Today it's down 8% alone. So a lot of fear that, with the AI becoming a bubble, perhaps, stocks like this have really taken it on the nose over the last couple months. Yet the company continues to have really great numbers. So the valuation is C minus now versus a B plus 6 months ago. So the valuation is still more expensive than it was. But as I mentioned, the stock has really come down. However, importantly, growth is much better now than it was 6 months ago. So the overall growth grade for the company versus the sector is an A, where 6 months ago, growth versus the sector was only a C plus. And that's part of the reason why year to date, the stock is up 173%. If you look at it on a 1-year basis, it's up 239%. So it's had a real nice pullback here. And I'm not a technician, but this almost could qualify as a head and shoulder. which is usually a positive sign for a stock. Um, so the Wall Street consensus is a strong buy in the stock. Our quant system has a strong buy in the stock, and the Seeking Alpha contributors have a buy. These are three independent sources right here. So one of the nice things about the premium platform is you are getting independent views from our contributors, Wall Street, and the quant system overall. Digging into the growth here, you are going to see a straight A report card for this company until we scroll down to a couple of the numbers over here. But for the numbers that really matter, which are revenue growth, EBITDA growth, EBIT growth, and earnings per share growth, it is a straight A report card. Forward revenue growth at 13%. Had been year over year. They had a stellar year with revenue growth. It was up 40%. But even going forward next year, it's 13.91% compared to the sector at 4%. But then when we drop down to earnings per share, if we look at the forward earnings per share estimate, it is 51% versus the sector just at 10%. So EPS growth for this company much, much stronger versus the sector. Taking a look at the profitability picture, you could see if we look at the net income margin, it's an A. And if you look at the return on common equity, this is huge. Return on equity for this company is 138%. Most banks would be completely envious of that type of ROE. The sector is only at 12%. So just an incredible statistic there for this company. Return on capital getting an A plus as well as return on total assets. So most of those figures looking stellar for the company. Cash per share, C plus right in line with the sector, but very efficient company. If we look at net income per employee, comes in at 158,000 versus the sector on average about 22,000. So very, very efficient company.
I also want to mention that this company does announce earnings tomorrow after the close. So we're going to get that update. They beat on earnings last quarter. And you've seen, of course, the quant, if you go look at the historical grades, the quant adjusted for that and the revenue numbers. But as you look at the earnings there, I mean, completely just been doing excellent in the build out of AI. So we'll hear what management says. We'll see what they release tomorrow, but definitely one to keep on your watch list here, especially since it's pulled back so much.
Yeah, and it's interesting because the company has definitely benefited from the demand and for energy, making data centers more efficient. So tomorrow we see the numbers meet the tape, and we'll see if the market, which is projecting obviously through the stock price coming down, that there should be weakness of earnings come through for the company. To me, it'll be a real indication that it's not a bubble. This is real growth that we've been experiencing because of AI. So I'm going to take back to our slideshow again. Stock number 4, Jackson Financial. This is a regional financial company, but a diversified financial. Market cap is 6.3 billion, and the financial sector currently ranks 29 out of 684. But within diversified financial services, it actually ranks number 1 out of 8. They provide a lot of retirement planning solutions and a suite of annuity services, particularly strong in Florida. You can see that the company, if you look at our card here, in terms of valuation and growth, the valuation has been pretty steady. Growth has been pretty steady. Profitability has actually improved dramatically. Profitability for the company is now an A compared to 6 months ago, where it was an F. Momentum is now looking better for the stock than the sector where it was 6 months ago. And analyst revisions looking good with a B plus grade compared to 6 months ago, it was a D. So on a number of fronts, the stock is looking really good. If we take a look at trailing PE, it is dirt cheap at 4.5 times. It does have a nice dividend yield too, as well, at 3.42%. The earnings per share growth for it is 23%, a huge premium to the sector. And this company, in terms of its cash per share, has a whopping $66 in terms of cash per share. That is tremendous versus the sector. And analysts continue to be positive. In the last 90 days, 3 analysts have actually revised their earnings estimates up, and no analysts have revised it down. Going to our final stock, number 5, Upwork, which I cannot understand why this stock isn't higher. I'm going to take us to the platform. The market cap on this company is about $2 billion. It's got a quant strong buy on it. If you're not familiar with Upwork, it is known as a human resource and employment service company Within its industry, it ranks 1 out of 29. This company is very popular with entrepreneurs that are seeking help, whether it is with coding and developers or accountants or marketing. You can go to Upwork and get just about freelance from any investment professional that you could possibly think of. And freelancers are becoming really much more efficient with the use of AI. So I'm going to take us to the platform, to Upwork, and you're going to see why I am so interested in this stock. So we can see the stock has come off sharply from September 19th, where it was at $20. It's now $16. So really a very big pullback. Year to date, the stock has been like a big zero. It's down 1.2%. But let me show you why I like this stock. If we look at the growth for the company, and we're going to click into growth, you're going to see some really good EPS numbers and EBITDA numbers here. So our forward EPS growth rate is 157%. Okay. If we look at the year over year growth rate, it's 179%. So a lot of companies, maybe they had a good year for earnings per share. We're looking at a 1 year period there, up 179% versus the sector at 6%. But here, using analyst estimates, the forward growth rate is estimated to be 157% compared to the sector at 10%. So that is just huge, huge earnings power for this company. So that looks really attractive. If we look at it on a free cash flow per share basis for a growth rate, it's at 66% versus the sector at 8.7%. And operating cash flow year over year is 26% versus the sector at 5.6%. Return on equity growth. So this is actually looking at the growth rate of return on equity year over year, 108% versus the sector at a negative 3.8%. So to me, this is a really awesome growth story. And when we look at the valuation on it, it's really inexpensive. When we look at the forward PE, it's 18.3 times versus the sector at 23 times. And if we look at the trailing PE, it's 9 times versus the sector at 25 times. On a PEG basis, which is one of my favorite ratios, because you actually combine PE with the growth rate, it is an A plus coming in at 0.05 versus the sector at 1.22. The valuation framework has us on a PEG basis at being at a 95% discount to the sector. So to me, this is really interesting. And it's a smaller company, but if we look at profitability, gross profit margins of 77%, EBIT margin of 17%, EBITDA margin of 19%, and return on common equity at 47%. This is a very, very profitable company. So it's got a great growth rate. It's got a really good profitability picture and an excellent valuation framework. And the stock has come down from $20 to $16. So I think, partially this really reflects a lot of the nervousness with AI and its impact on labor, with perhaps just the rotation into safe haven stocks really starting to occur as much as 4 weeks ago with names like Upwork, and you're just starting to see it in the indexes now. So I'm feeling really comfortable with these recommendations today. And I'd say continue to buy on the dip if the market does rotate, because we will see stocks come off when markets do rotate into safe haven stocks. They sell stocks that have good fundamentals. Happens all the time, like clockwork. Doesn't matter how good the fundamentals are. If people get nervous, they seek cash, they seek consumer staples, they seek utilities, they seek healthcare, and they rotate out of the quality names. And that is your time to shine, because if you realize that, you will buy many of these stocks as they pull back. So here are our top 5 mid-cap stocks. Many have already started to pull back. We have SSRM, we have TTMI, PSIX, Jackson Financial, and Upwork. Really good grades across the board with looking at valuation, growth, profitability, and positive analyst EPS revisions. And if you are not familiar with my work, we're actually going to have an article out on this company tomorrow. It will be released at 5 a.m. So you can take a deeper dive into the article. It'll be a fairly quick read, but it will have some more detail to it. And please click on follow me so you can continue to get much of my other research that I produce on a weekly basis. Daniel, do you want to tell the audience a little bit about Alpha Picks at all?
I would love to. So obviously, if you joined any of these webinars before, you know we love to provide you value. We give you these picks, these ideas to go look into further. This one's very unique, being in that mid cap range. Typically, we have themes that we like to present to you as well of companies with great, strong growth metrics. But maybe you don't always have the time to go and read all these articles or watch all these videos. And that's why Alpha Picks was kind of born. Is for those people that just need help. 2 stock picks a month. Research is presented, just right delivered to your inbox, to your mobile device on the first or the 15th trading day or the immediate trading day, depending if it's a holiday or weekend. That's kind of the service for you. But I also want to mention Pro Quant Portfolio. That's more for those active traders, for the people that are looking for stock ideas every single week. That is definitely the product that you're going to want to check out. We launched that in June and people have been loving it. The returns have been coming in very, very well. We have made some recent updates from here and get some great feedback from the audience over there. So if you haven't already, check out Pro Quant Portfolio and Alpha Picks here on Seeking Alpha. They're both model portfolios ran by Steve and his team over there. It's all quant based, all systematic based, because we know removing the human bias and removing those emotions have led to great returns year over year. So highly encourage everybody to check those out. I'm gonna drop some links here in the chat. If you're watching the video replay, you can find those links below this video as well. But yeah, Alpha Picks and Pro Quant Portfolio. That Steve, anything to add on there? Because if not, I want to jump in.
I'll mention the Alpha Pix has been out about 3.5 years. So it's got a longer track record. If you look at the right side, you'll see it's up 273% compared to the S&P, up about 80%. Year to date, Alpha Pix is up 44% versus the S&P up 15%. Again, that's a service where we just provide you with 2 picks a month. So it's done incredibly well. The Pro Quant portfolio we just launched really at the beginning of June, but it is off to a stellar start. That is an equal weighted portfolio of 30 stocks, but we rebalance on a weekly basis. So you get ideas every week from us. And that portfolio is up 37% versus the equal weighted S&P at 6.4%. And the on a market cap weighted basis, it would be up about 15%. So really crushing both indexes there. Both really with a terrific track record.
Yeah. And I want to mention as well, because people always ask the cost of those. So I know Pro Quant Portfolio, there's usually this ongoing entry cost of $99 for your first month and then renewal at for an annual full cost. I believe it's $27.99. I need to double check that. Don't quote me on that. But Alpha Pix is $4.99 for the year. Now, they're depending when you see this, you hear it here first. I'm not sure if I'm supposed to share this with you, but Black Friday is around the corner, so you might want to keep your eyes out as well. So keep an eye on that. We've got some great things coming down the line there for you and these products. So if you want to explore them, please go ahead, click on those links I dropped in the chat. If you're watching the video replay, you can find those below, and you'll see right here in this table a nice little rundown for you, because obviously everybody trades different, everybody invests different. So we try to meet you where you are, and believe me, we hear you. We definitely want to be there for you. So the community there is amazing. I mean, very like-minded individuals challenging each other, and everybody really loves it. So I highly encourage you to check it out. Steve, anything else before we jump into some Q&A?
Yeah, let's hear the Q&A. Absolutely.
All right, we got a few questions here about the quant system. I think that's a good place for us
Sure.
to start. So there were a few questions of, I kind of mentioned it in passing about how the quant system updates every single day. So there was a question that came in. We've been talking about earnings because it's obviously earnings season, but how fast does the quant system factor in the earnings when they're announced?
So if earnings come out this evening at say 4 o'clock to 4:30 p.m., it will be factored into the model the next morning.
And so if it's a morning call, then it'll be the next day.
If it's a morning call, it'll be the next day. Most companies seem to report at the end of the day. There are a few that do pre-open. So that would be an entire day's wait. But if a company reports in the evening, we have it in the model the next day.
Brilliant. Thank you so much there. Then let's talk about SSRM. A question came in about, it's a mining stock. And so people have been watching the gold run up, and we've obviously seen quite a bit of a recent gold pull back. It's kind of around that $4,000 level now. Do you have any worries about, stocks like this that are so tied to a commodity?
I don't necessarily have worries about it. It's an important asset class to make up an overall diversified portfolio. The quant model, though, it really has like a bottom up approach, so it focuses on companies. Again, we look for stocks that are collectively strong on value, growth, and profitability. So if it's highlighting a stock on those metrics, it means it's an attractive stock. It's an attractive company. So I'm really agnostic actually to what the sector is. I'm agnostic to who the management team is. I just want to see good data. And if we have good data, the quant system likes it.
Yeah, and speaking about that data, so that leads great into this next question that came in. Can you speak to the quant factor grades and highlight which ones that you believe are the most important for stock performance?
So the approach that we use, that's a really good question because some quant models will focus just on momentum, others will focus on growth, others will focus on value. For our system, we really use what I often refer to as a GARP approach, which is growth at a reasonable price plus, and that plus would be the momentum factor and the EPS revision factors. So it's that GARP plus. I think that diversification in factor styles is really important. Now we'll have, with having said that, within each of these groups, there are some metrics that are better forward indicators in terms of stock price, better predictors than others. So when we look at valuation and we look at the valuation grade, we're not taking all the underlying metrics on an equal weighted basis. Some of these metrics based on our back tests, which go back to 2010, and for me, really much longer since I've been doing this for so long, we know that certain factors have greater predictability than others in terms of future stock price. So these are not equally weighted, but we do come up with an overall value. And sometimes, Daniel, people will say, well, your grade, your underlying metrics don't seem to make sense because they're like a different color than the overall grade. And that's because we don't reveal what the weights are. Some of them have, as I mentioned, have a higher weight. Some of them have a lower weight. Some have no weight. But we just provide them because these are common metrics that people like to look at. So I hope that answers the question.
All right. I do need to make a quick clarification. I did have the incorrect data. PSIX actually just announced earnings a few minutes ago here while we're on the call. Stock's up about
Woo-ha!
percent after hours. We did
Look at
have
that.
some call outs here in the chat that, head and shoulders pattern that you mentioned is actually bearish. Luckily, it looks like you're a better quant than you are a technician, Steve. So we're gonna watch that stock and monitor it going forward. But they did announce earnings. It was a beat on the top and bottom line.
Yeah,
Beat
the
by
stock's up
about
almost 5%.
50, yeah, almost $50 million on revenue on that beat. So we love to see that there. So if you would have bought in when we talked about it, you'd probably already be up.
Yeah, and interesting, Daniel, one of the things I did say, we're gonna see if the talk and meets the talk and the walk meets the walk with this when they report, because the stock has come off a lot based on fears and sentiment that the sector is in a bubble, based on fears that the market's going to be rotating, and we haven't seen that really in the indexes, but we have seen that in some of the smaller and mid cap stocks. This one off sharply from 110 down to $81. But what I want to highlight is if the company comes out and they beat earnings, it's the real deal. And stock trading up in 5% in the aftermarket. And what was a down day for the overall market? I think, Nasdaq down almost 2%. The S&P 500 down 1.1%. So definitely a down day. So really good numbers out of PSIX. Very
Earnings
pleased.
matter. That's the
Yes.
great takeaway. Earnings still matter. Everybody remember that. All right, here's a question for you from Robert. It says, in the pro quant portfolio, Steve, how many trades per month on average does it take? Kind of asking about
Uh,
this.
well, what I will tell you is on average, we look at it a weekly basis because we rebalance on a weekly basis. There's about 2 to 3 trades per week. However, I will say there are some weeks where we have no trades, and there are some weeks where we might have 6 trades. So over time, dating back to 2015, using the back test, it on average is about 2 to 3 trades a week. Um, for the last month, I think it's been trading less than many people would have expected. And that's because so many of the material stocks had done well. But as the markets are starting that rotation, I believe we'll start to see some more trading involved with that.
All right, well said. Now, there's a question that's been popping up here a few times about short interest. I think specifically, it was pointed out when we mentioned Upwork has a short interest north of over 8%. Do you worry about short interest on stocks like this? I mean, you kind of see higher.
Actually, what I love about short interest is when I see a stock that has solid fundamentals like Upwork and people are shorting it, to me, that implies that there's the potential for a short squeeze on the stock. So obviously some hedge funds have made a bet against the company that has solid financials. And the problem is, like, there are hedge fund research companies out there that are paid to put negative reports out there. And sometimes they can have a real negative impact because you'll see a lot of concentrated selling occurring when those reports come out from massive hedge funds. And sometimes it can have a short-term negative impact. But if the company's got good fundamentals, over a couple quarters, it really comes through. And if you have a high short interest rate and your fundamentals are strong, I feel bad for the hedge funds.
Yeah, no kidding. All right, Steve, well, let's go ahead and wrap it up there. We provided a lot of information today. Everybody, you see those stocks there: SSRM, TTMI, PSIX, Upwork, and I just missed the first one, Jackson Financial. That's right. So everybody, thank you so much for hanging out with us today. This has been another great webinar. As always, we hope you found a lot of value here. And as I mentioned, if you haven't at least followed Steve on Seeking Alpha, which is the free thing to do to get some more of his research and keep an eye on what we're doing over here, go follow him there. And then also check out Alpha Picks, Pro Quant Portfolio. Like I said, those communities are really awesome. The portfolios are doing well. We're always on top of the engagement and ensuring that we're right there, keeping you updated with the webinars monthly. I mean, like I said, the team's always in there in the comment section of the articles. We are there explaining what's going on. So everyone, thank you so much for taking the time to hang out with us. Hopefully the markets stabilize here in the little bit future, but we'll see what happens with the shutdown, right, Steve? So
we'll see. It could be
can't
an
tell the
opportunity.
future. Yeah, follow the
so much
quant
for your time.
system and sleep on at night, right? All right, everyone. We'll see you in the next webinar. Take care.